Namaskaram. Today I am with another podcast. Today I am trying to learn how to invest in AIF and how AIF work, alternate investment fund work. And let's welcome Nishad sir, Nishad Khanolkar. He's from the Wealth company and another new entrance to mutual fund. But before entering into a mutual fund, they are pioneers in AIF mode of investing. So today's effort is try and learn what is AIF in general and what Bharat value fund which you are trying to address, and what kind of investors should be good for that, and how investors can invest and make use of that kind of investment vehicle. So first of all, welcome.
Thank you, Nikhil. Thank you.
Thank you so much for taking time out in your short visit to Kerala. And first of all, thank you for coming to Kerala. And second, thank you for giving time out for this. And you are a chartered accountant, you are a CPA, and you have worked in private wealth companies. You are a Mumbaiker, then you moved to, you worked in a Hong Kong company, then now in the last 4 years you are a director and founding member of the Wealth company, and you are a part of investment committee also to secure fund for investors who are investing in your Bharat value fund. So quickly, if you can introduce yourself with your childhood and how did you get attracted to market, and how you are enjoying today's the current work which you are doing. We can start with that. Yeah.
Sure. Namaskaram, Nikhil ji.
Namaskaram.
And thank you for inviting me on this podcast. Before we start, as a matter of practice, since we both are working in a SEBI registered environment, I request all the viewers stroke investors that they should consider our podcast only for the investors education and awareness purpose.
Yeah.
I'm not going to do any marketing exercise over here because I do not like to do marketing. I'm going to speak from my heart.
Yeah, thank you for clarifying that.
Of course. So before you ask me about the wealth company, you asked me to introduce about myself.
Yeah,
so
first.
My name is Nishad Khanolkar. I'm a chartered accountant. I passed my CA in 2002. Then I did my CPA from Australia. And before starting Wealth Company, 11 years, I was a CEO of a Hong Kong-based private equity fund called SP Growth Partners, managed by the Silverdale Group. Mm-hmm. So I was lucky in that when I was working with Silverdale Group, I got a chance to closely work with Goldman Sachs teams.
Okay.
So that's where the first upbringing of the private equity culture started getting inculcated in my upbringing. Mm-hmm. So drafting about the shareholders agreement, negotiating about the investee companies with the promoters. So that cultural inculcation, I came from the Silverdale background, and of course little bit about Goldman Sachs, because ultimately Goldman Sachs was managed by the Jews community, and as you know, the biggest businessmen in the world are Jews.
Okay.
So that upbringing I got it, and then 2021 when the Wealth Company started, I became the employee number 2.
Okay.
So when Wealth Company, earlier they were a Pentomath group.
Okay.
So Pentomath was the India's largest mid-market merchant bank.
Okay.
So Pentomath has done 119 IPOs as a merchant banker in last 13 years. Mm-hmm. So when Pentomath wanted to start its own AIF, alternative investment fund, I joined them. Okay. So Ms. Madhu Lonawat is the director and the founder of the Wealth Company and employee number 1. Mm-hmm. I became the employee number 2. Okay. So April 22, Nikhil ji, we started.
Okay.
Honestly, on April 22, the Wealth Company's AUM was 0.
Okay.
And today, if you look at the asset under engagement of the Wealth Company is close to 12,000 crores.
Okay.
In 4 years. From employee number 1, employee number 2, right now we are 450 employees almost.
Okay.
In 4 years span. And the main two functions of the Wealth Company are, of course, our flagship product, which is AIF category 2, Bharat Value Fund. Mm-hmm. And recently, as you rightly said, we have also got the mutual fund license, probably the youngest to get the mutual fund license. And mutual fund we almost started 5 years ago, which is also doing reasonably well. Okay. And before I start anything, special thanks to you and special thanks to Kerala. I would like to mention one thing before you ask me the next question. Nikhil ji, whenever you start your career, that's what my policy is there. The person who helps me when I'm at the beginning phase of my career, I would always remember that person for a long period of time. So when we launched the series 1 in my AIF, it was relatively tough. Today I'm talking about 8,000 crore. In fact, my first series, it took me a very long time to raise the money. But that time, Kerala was the area where I got the maximum chunk of money in my series 1.
Oh, okay.
So that is the reason I love coming to Kerala and I keep coming to Kerala. So special thanks to you and the people of Kerala for supporting me in series 1. So special thanks to you. And that's how I am being upbringing. My upbringing is always give respect to the people who have supported you when you are lesser known.
Okay, that's very good. Actually, that's I think Kerala has always a flavor to take the risk and understand that what is new coming in, and that's good. And so you speak about your journey and the wealth company's journey. Can you just talk about your childhood and how did you enter into market? And just to understand you as a person, because it's always curious to see that how people really get interested into market. So when did you start open the demat account, or when did you buy the first share? If you can talk about if you remember.
Yeah, I remember. So instead of being chartered accountant, coincidentally my wife is also chartered accountant. And I'm very honest with you.
Okay.
Trust me, my personal finances are managed by my wife.
Oh, that's good. That's a one best practice you can have in the family. Yeah.
And because I have the experience of closely working with Goldman Sachs in earlier career, they have told me one thing. One thing I learned from my Hong Kong experience is, if you believe in something, you be the first person to invest.
Okay.
Nikhilji, trust me, last 2022 till 2026, last 4 years, whatever I have earned in wealth company, salary, bonuses, this, that, other income, post taxes, more than 80% I have invested back into all the products of wealth company.
Okay.
Because I have a conviction. If I do not have the conviction, I can never tell you, Nikhil sir, you invest. So that's where it started. When I was working in Silverdale, I used to invest in their products. So first demat account, initially I started with the real estate investment, because when you get married, the first intention is to buy your own house and pay that EMI. I have gone through all those things. But when that reasonable comfort of lowering down the EMI came, that's where I started going to equity. So to answer straight away, I think my first demat was open in somewhere in 2006, 2007, if I'm not mistaken. And there onwards, I started investing regularly into the listed market. So I always have the mixed portfolio of listed market, unlisted market, gold, silver, real estate. It's more of a balanced portfolio.
From the beginning?
From the beginning. And I'm always a long-term investor. I'm yet to remember if there's any asset class which I have sold in less than 2 years. I'm yet to remember. I doubt if I have done that in my life. Not even me, not in my wife. Since this is a personal question. And same applies to my fund also. Fund also believes in a reasonably long term, because if you really want to mature your investment, you need to be a long term investors.
Yeah. It's very happy to see that from the beginning you had that maturity or the knowledge to hold on to the belief. Normally people become the trader first, then they slowly become the investor at the later stage. But you from the beginning itself, you had that conviction to do that. That is a good to know information. And another thing is that this is another thing which I always try to see in my clients. Normally when clients comes to office, men comes to office and do the financial planning and start managing fund. But I always believe personally that the moment that person come with his wife, and as a family they come and do the review meetings, that is the time I really understand that, that family really get into the person. I always see that is one of the success criteria for that family to take the family wealth in a proper way. So you have done that in initial stage, and you are doing it. So I can really see that my assessment here is correct also.
Of course, Nikhil.
So we'll quickly move to AIF, what we do, because I know that mutual fund also you do it, but I think today's podcast we specifically look for alternate investment fund. So what is AIF for anyone who can understand in a very simple language?
So AIF is alternative investment fund. Right now the regulators have allowed 3 categories of AIF: category 1, category 2, category 3, in a very simplistic way. Category 1, Nikhilji, is more like a startup venture capital fund that comes into the category 1. Category 3 is more like a listed. In category 3 you have a more exposure to listed as compared to the category 2. So most of the time you see the category 3 performances and mutual fund performances at times go in a similar way, because category 3 has larger exposure in a listed atmosphere. Though category 3 is allowed to go into the unlisted, but a lesser percentage. Category 2, What I do is unlisted to be listed.
Okay. Now unlisted, but it will be
It will be going to the listed.
their exit will be listing.
Their exit will be listing. So that's called 3 categories: category 1, category 2, and category 3.
Okay. And you speak about your private equity experience. So can you just tell that what is private equity, what is merchant banking for audience to understand? So,
Okay. So in a very simplistic way, merchant banking is the license issued by regulators to do IPOs. You see various IPOs coming into the BSE and NSE. So when you apply to the regulators, okay, that document is called DRHP, Draft Red Herring Prospectus, which regulators approve or disapprove. Only when it is approved, the company can go for IPO. So when the DRHP is submitted to the regulators, various agencies work behind that. But there's only one agency, so you can call it like a captain. There's one agency which reports to the SEBI. That agency is called as merchant banking. They are solely responsible for the outcome of the IPO. So if the IPO goes well, definitely the merchant bankers get the due credit for that. So as a merchant banking unit, Pantomath has done 119 IPOs in last 13 years.
okay, that's a parent company of
That's
Wealth
the
company.
parent company of the wealth. And then when it comes to
Private equity.
so what we do private equity in my especially fund. So Nikhil ji, in a very simplistic way, I can explain my 8,000 crore fund, the theme of the 8,000 crore fund to you in probably 30 seconds. Because I always believe, if you know the end objective, then working is more better. You should know ultimately where you want to land. If you're doing a family planning or if you want doing any goals, you should know what is the end game. So I know my end game in my private equity very well. And my entire presentation for 30 seconds starts now. Invest in those companies which can go for IPO in next 3 years.
Okay.
Nikhil ji, very honestly speaking, Bharat Value Fund Series 2 AIF presentation is over.
Okay. So you pick the companies where you think that it can go in 3 years of the.
Absolutely. And who is saying this? Not a new kid on the block.
Okay.
The Pantomath group, which has done
Who has
190.
done, 190.
Exactly. That guy is telling you that, look, Mr. Nikhil, I'll take your money. I will go and invest in those companies, which I believe have the likelihood to go for IPO in 30 months. On a higher side, 3-4 months here and there is okay. So today I am into my Series 4, but Series 1, Series 2, Series 3, Series 4, whatever companies I have invested, there is one non-negotiable clause that I enter with the promoter. Say, for example, to your company. If I'm giving your money to you, for me, you are a promoter. There will be various negotiations between you and me. I'm okay to get negotiated on all the points. Even on valuations also, I can get negotiated with you. But there is one clause which I will not be in a mood to negotiate with you. That is, you have to go for IPO in 30 months. The moment you start negotiating with me on that clause, means you are blocking my exit.
Okay.
If you are blocking my exit, why should I enter, sir? Will you enter a roller coaster without looking at the exit?
Okay.
You'll first look at the exit, then you enter the roller coaster.
Okay.
Same in my fund also.
Okay.
First exit, then enter.
Okay. So you spoke about we spoke about venture capital also. So what is venture capital?
It's more like when you start the company. At the first come is the seed funding. When the project is still on the paper. That time the seed come, the friends and family come. As you grow, then little bit.
Somebody is investing based on your knowledge to the
Correct. That's seed. When the little bit grown happen, then the venture capital comes. They're like a very early stage. The level of risk differentiates based on the level at which you are entering. So of course, when the mutual fund invest, that time it is approved by the regulators. The company is fully grown up. So that depends upon the various stages. So seed funding, venture capital, private equity, and mutual fund. These are the typical stages that are followed.
Okay. So quickly, how can you differentiate PMS and mutual fund versus AIF?
You're talking straight away from the returns point of view, or
No, in general, what is it? Return point of view, I think we can talk about later.
Okay.
But in general, how can you differentiate?
So PMSs invest only into the listed. PMSs will not invest into the unlisted atmosphere. PMS and mutual fund, the only difference I can see is the PMS guy is a more dedicated approach towards your investment. Ultimately, the spectrum available for the investment for the PMS and mutual fund is one and the same. So most of the time, if you look at the portfolio, if you have a PMS, if you have a mutual fund, if you look at the portfolio, is one and the same. What I can do is I can slightly go behind.
AIF can do.
Exactly. And start investing into the unlisted. What is the benefit? The biggest benefit that AIFs have is, we always say that if you want to make money, okay, there is only one way you can make money in fund management, and that is enter low. Let me explain. Say this bottle is for 10 rupees. Correct? The best marketing guy in India cannot sell this for 12 rupees. You can make money if you could buy that for 7 rupees. What does that mean? Enter low.
Okay.
Enter low is the only way you can make money in fund management, and that entry can come if you come slightly before IPO.
Okay.
Because once the IPO comes, the liquidity increases. Mutual fund comes, PMS come, HNI like you come, ultra HNI come, retailers come, everybody comes, the liquidity increases, the price slightly goes up. So we as a AIF have ability to go slightly before the IPO.
Okay.
So where the price discovery has not yet happened, so that is where we enter low, and that is where my return lies, because I enter low.
Okay.
So
Okay.
I make money. I always say to my investors that technically I make money on the date of entry,
Okay. Not at the sale.
not at the time of exit.
Yeah.
Because once you bought it for 7 rupees, even if the market goes up and down, you have created your cushion.
Okay.
Because market is not in anybody's hand. That is going to go up and down. It is going to have a cyclical behavior. You enter low, you clear your compliances, people will come and buy you.
Okay. Okay. Great. Great. So you were speaking about Bharat Value Fund as such. So now we are at Series 6.
Correct. Series 6 is almost coming.
Almost coming.
Almost
So can you talk about last 5 series of Bharat Value Fund? Then we will move on to the Series 6.
Yeah. So Series 5 is, I'll slightly keep it aside because Series 5 is for the real estate.
Okay.
Of course, I'm also on the IC of the real estate, but Series 5 is for the real estate fund. But Series 1, 2, 3, 4 were for all private equity. So Series 1 we started on April 22. It was a 500 crore fund. And it was a long time to raise the money because that time we were new kid on the block. So new entrants, slightly difficult to raise the money. That's where Kerala people gave us the support. So I guess it took us 18 months
18 months. Okay.
to raise 500 crore.
Okay.
Just to raise the commitment of 500 crore. But today, Nikhil, I have a pride in saying, if you look at the latest, because every 6 monthly we release the report, the latest release report, those who have given me 1 crore, as per the statement we are given, they are sitting at almost at 2.8 crores.
2.8 crore.
One has become 2.8 in 2 years from the final closing.
Okay.
So you can calculate the return, how much it comes. Most of the time, if you have seen you asked me about the difference between PMS and AIF. You can see last 17 months, whatever PMSs have given the return and whatever I have given, it surpasses that because I entered low. When he gave that performance, the second series was almost 4 times bigger than that, 2,000 crore. And it took us probably 4 months, 5 months to...
Okay. First you took 18 months.
18 months to
to raise 500.
500.
And 4 times of that raised in 4 months.
Yeah, exactly.
Okay.
Exactly.
Brilliant.
And that fund, we took it to the international market. So 10% of that fund came from international market.
Okay.
So that's where we got the benefit. That is also today, if you look at as per the latest report, it is 50% up.
Okay.
Then we launched the Series 3, which is almost closing now.
Okay.
2,500 crore fund. Series 3, for the first time, we took it to the GIFT City.
Okay.
Because once the popularity of the fund started increasing, awareness of the fund started increasing, the NRIs wanted to invest into India. But their requirements were slightly different. So they pushed us to have the overseas feeder fund. So Series 3 has an overseas feeder fund in GIFT City. So all the NRIs were sitting in Dubai, US, UK, Canada, even Kenya are investing in my feeder fund.
Okay.
So you come into the feeder fund will invest only and only into the principal fund. So technically the returns are not differentiated, but the benefit you get, you invest into dollars into feeder fund and you get back into the dollars. So that is the biggest benefit you get for GIFT City.
So it's the same name, Bharat Value Fund?
Yeah. So principal fund is called Bharat Value Fund Series 3, which is in India. And the feeder fund is called Bharat Value Fund IFSC fund.
Okay. IFSC fund. Okay.
Correct. So feeder fund, most important, many times for investors' education and awareness, if you're investing in a feeder fund, you should always look who is managing the feeder fund. Not necessary. The feeder fund and the principal fund are managed by the same entity. Sometimes feeder fund are third party managed. So the element of risk slightly goes up.
Oh, okay.
But if you see in my case, the principal fund, Bharat Value Fund, and the feeder fund are run and managed by the same wealth company.
okay.
Same Nishad, same Madhulu Nawat, same Prasanna Bhatak, same Tejas, same team is there.
Okay.
So the IC committee is one and the same.
Only the structure is different.
Exactly.
Okay.
And a feeder fund can make investment only and only into the principal fund, nowhere else.
Okay.
So whatever money comes to the feeder fund has to invest into the principal fund only.
Your series 3.
Exactly, series 3. Correct, sir.
Good. And can you just summarize like how many stocks you have invested in and what level of investment came into listed and what level of came into unlisted?
So before that, I missed out saying something on this thing. The total number of investor base Bharat Value Fund has is close to 3,350 by now.
Okay.
With a minimum ticket size of 1 crore.
1 crore.
So that's a thing that I always wanted to mention. Normally what I do is, whatever corpus of the fund is there, say 500 crore, 2,000 crore, 80 to 85% money goes into the unlisted segment. 80 to 85%.
Okay.
So the game plan is there simple. Give it money to the company which want to go for IPO in 3 years. That's very simple. 15 to 20% money stays in a listed because 100% of the illiquid fund you cannot manage. So listed is basically you get the instant liquidity, listed, unlisted merger. These kind of options get available to you. So that is the reason 85-15 or 80-20 model we use. 80 to 85% into unlisted, 15 to 20% into listed. I'll slightly take 1 more minute into this question. This is very important topic you're talking. You know, we always talk about the returns. But I personally believe safety is more important. No? Higher risk, higher reward.
Okay.
This is what has been taught to us in a
MBA class. And
correct. I did CA, same education, CPA, same education. Nikhilji, I'm very sorry, I do not believe in this statement. Higher risk, higher reward, I do not believe. My statement is, lower down the risk, you can make money on the law of averages.
Okay.
You should have lesser accidents. Okay. It's like cricket only. Fund management is not a T20 game, sir. It's a test matches. 1 or 2 player playing a flamboyant inning and getting out on 0. Can you win the test match? No. All 11 players play sensibly. You can win the matches. So in cricket, you have 11 players. In fund management, I have 11 companies. I look at the same. Okay. It's the same concept. All 11 players play, you win the matches.
Oh, okay.
So, when the toughest situation happens, what saves you is called as concentration risk. So you have done a lot of due diligence on one company. In spite of that, at times, things can go wrong and that company fails. You know, that day what saves you? How much percentage of your wealth you are invested in that company. That is the only thing that can save you. So regulators say, this is a regulated product, that whatever is the corpus of the fund, no fund manager can invest more than 25% into one company. That's regulators say. But as a fund manager, we have taken a conscious decision. However good companies, I will not give more than 10% of my corpus to one company. Okay. Means what? If something fails, Nikhilji, 10% is gone, but balance 90% can still give you the return. Okay. So concentration risk is the very, 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 very important. The largest exposure in one fund I have is only 11%. No company has got more than 11%. And no sector, it's not only about the company, it's about sector also. No sector I have exposure more than 17%. So sectoral exposure is also not there because sectors can also go wrong. Because what happens, Nikhilji, if the sector goes wrong, technically fund managers cannot do anything. So again, I repeat my last statement. When the things goes tough, only thing that saves you is a concentration risk. Okay. So the fund is not concentrating on any company, neither it is concentrating on any sector.
So when you look at previous Bharat value funds, right? In that, how many companies were there?
So series 1 I had 12 companies.
12 companies.
Series 2 I had 12 companies. Series 3 also I'm expecting to have 12 to 13. So between 12 to, because again Nikhilji, let's derive you have given me 100 rupees. 85 rupees I'm going to invest into unlisted. 15 rupees I'm going to invest into listed. So 85 on an average I give 8% to one company. So 85 divided by 8 if you do, around 11-12 unlisted companies come and listed. So 12 to 13 unlisted companies. That's predominantly series 1, series 2, series 3 has been the scenario.
Okay, very good. And how many sector you have invested?
So on an average, each fund I have close to 8 sectors exposure. And largest exposure, needless to say, is food and agro.
Food. Oh, okay.
and that is 16%.
Oh, okay.
Only 16% of the total corpus. That also to be mentioned.
Okay, that's good. That's good. So I think even I like funds investing in this manner because most of the time, any AIF and PMS, when we look at it, we can see that 20, 30 companies or 40 companies listed, and it is more like mutual fund only. And I'm not really blaming that way. Maybe that is one manager style. But as an investor, at least one difference I always look at is that mutual fund is you have everything. And PMS means it's little more concentrated. But that concentration, sometimes we miss it. And especially in AIF also, most of the time, I think 80% will be listed space also. So that is the reason as a advisor or a distributor, you find the difficulty to really understand the difference.
Yeah. I completely agree with you.
Yeah.
Completely agree with you.
Yeah. So if you look at Series 6 and other series, what is the difference, or is it the same?
Oh, yeah. Slight difference because Series 6 is, we are trying to name it as a fund of fund. Fund of fund. So Series 6 is a fund of fund. And for the first time, we would try to keep the ticket size to 1 crore only. Because many a times if you see the Series 3 or Series 2 and towards fag end of the series, the ticket size goes to sometimes 10 crore and 15 crore. This will be a flat 1 crore entry. So being a fund of fund, what Series 6 is going to do is they are going to have basic 4 parameters. As I said, we are also qualified anchor, just like mutual fund, insurance and bank. Anchor is called as they get the confirm allotment before the IPO. The IPOs which you do not get, you apply and invariably you fail to get it. Anchor get it. So we are qualified anchor. Mutual fund, insurance, banks and AIF are qualified anchor. So what I can do is probably, this is what we are planning. Series 3, which is almost most of the investors have missed out. Okay. So BVF 6, Series 6 can get entry into BVF 3, can get into BVF 4, can get into the listed on a momentum base wherever the market has fallen, and can get as an anchor investor also.
Okay.
And technically as a layman, you cannot get entry into all 4 of them because Series 3 is almost closing. Series 4 is ticket size is relatively higher. Anchor, HNI do not get qualified because only mutual fund, insurance and bank gets qualified, and momentum based equity. So you will have a perfect portfolio of, because Series 3 will have 12 companies, Series 4 will have 12 companies. So there you are very much diversified. Plus one big point. One of my investors said he wants to come in Series 3. I said, why are you coming in Series 3? So he gave me a very nice answer. He said, Series 6 is technically likely to have early liquidity.
Okay.
Of course, because Series 3 is already ahead. They have already made few investments. So those companies in Series 3, they will go for IPO in 30 months from their date of investment.
Okay.
So his point is Series 6.
You don't have to wait like the actual investor date.
Correct. So Series 6 has a tendency to go for the early liquidity.
Okay. So just to miss earlier, what is the kind of a duration you keep it for each series?
We always say it's 5 years.
5 years. Okay.
And the shortest tenure. Most of the private equity fund I have seen in India 7 years, 8 years, 9 years. Sometimes startup funds I have seen like 10 years also. So this is 5 years from the first close. I'll go slightly slow because this is an important point. So my fund is 5 years or 5.5 years from the first close. So technically that does not mean I'm going to use your, suppose you give me 1 crore. That does not mean I'm going to use your entire 1 crore for 5 years. No. You are giving me a commitment of 1 crore. You are not supposed to give me 1 crore tomorrow morning. No.
Okay.
Right now in Series 6, we are talking about you have to give me only 20% or 25%. Means 20 lakhs or 25 lakhs. The balance, normally we have a tendency to call once in a quarter.
Okay.
That has been a historical trend. Every time I call the money, I give you proper 21 days notice. It's not that I call you tomorrow and give me money day after tomorrow. No, that is not going to happen. So you have relaxed timelines. The overall 1 crore drawdown historically has been between 9 months to 12 months. Okay, very important. I take that money, I invest into various companies. As and when I exit, Nikhilji, I return the money. I never redeploy.
Oh, okay. So the moment you get an exit, one company, whatever that portion belongs to me, I'll get it.
Correct. So classic example, I invested in a Rajkot-based company called Silver Consumer Electricals from a Series 1. Nikhilji, as a fund level, I have invested 25 crore into that company. 25 crore. After exit, the fund had got 216 crore in 18 months. 25 crore we invested, we got 216 crore. The day we got the money, Nikhilji, within 15 days, that 216 crore went back to the bank account of the investors, in the ratio of your units. We did not redeploy.
Okay.
The day we got 216 crore, the fund was still 2 years to go. The fund life was not ended, but I returned the money. So technically, if you see, so what regulators say, the first entry and the last exit is 5 years or 5.5 years. But the cash flow point of view, it is 3.5 years fund.
Okay. So this particular stock, which you have invested 25 crores. So what was the percentage of allocation?
That time percentage of 500 crore fund, so 25 crore is for 5%.
5%.
So one exit has
five, so my 5 lakh, I got 10x of it.
Yeah, exactly.
That's also so beautiful. No, it's good. So can you just take a little more elaborate on success of each of your series? And I don't know whether you are allowed to speak about companies. So can you just talk about the how all those series, starting from the level series 1 to series 2 and up to series 5. How was it? Continuation of what we spoke now.
Yeah. So series 1, as I said, that it was slightly challenging to raise the money. But today, if you look at the series 1, okay, which is almost 2 years from the final closure. Final closure is the day you save to final investor. Now, no new investors can come. Technically, the fund is sitting on the entire principal liquidity. Is fund is sitting. So that's how the fund has performed. So in 2 years, the fund is in a position to return 100% of the principal back to the investors. Whereas if you see, normally most of the fund managers which I have seen in India, the normal trend is 2 years are taken to deploy the money.
Okay.
Where in series 1, in 2 years, you're in a position to liquidate the fund. So that's where, and one thing I learned, Nikhilji, you take the money, you return the principal. The investors are very happy.
Okay.
So that is the basic thing. That is the reason whenever we exit, we return the capital back to the investors. I might ask you the money in the next series, but I'll not redeploy that money. At least unlisted exposure that I take, I never redeploy.
Okay.
The listed exposure 15% is a different story. But the unlisted exposure 80 to 85%, that I never redeploy.
Okay. So when we talk about this one, so 80% you are investing in unlisted space. So that is close to 10 to 12 stocks you invest, right?
Well,
so out of that 15, how many stocks you will be deploying? Out of the 15% of listed stocks.
15% listed stock. Okay. Historically, the 15% listed stock, I have been 4 to 5 companies, not more than that.
Okay.
Not more than
that. That also keep on churning or?
No, we have not churned till today.
Okay.
But I would keep that option open for me. Whether if I want to churn, I can churn. But till today, we have not churned in a listed.
Oh, okay. Could you just mention a few of the good companies in last series which you consider as a top picks and stuff like that?
So let's take example. My one of my investment was, I'm sure you know, Prabhuji the Haldiram very well.
Okay.
So if you look at the Prabhuji the Haldiram, I have 90% exposure. The Calcutta, whose brand ambassador is Mr. Shah Rukh Khan. Then recently I have invested in a company called as Amnex Technologies. Since you're a finance professional, you would love to know the financials of Amnex. They have a revenue of 750 crore and with a profit after tax of 155 crore. Okay. Such a beautiful company they have.
Okay.
So there are various companies that's on my website. But if I slightly tweak your question and I would like to say what is the common parlance in all the investments I have done. Then I would say point number 1, all the companies I have invested, I have right to take them to IPO in 30 months.
Okay.
The most important factor is most of them are asset backed.
Okay.
Plant and machinery, land and building. If assets are not there, they have orders in hand.
Okay.
Point number 3, very important. You talk about any company. The promoter means the owner. Has a substantial stake.
So substantial, what's the percentage?
Substantial in my dictionary should be more than 75% at least.
Okay.
Substantial in my dictionary, because what happens, sir? Ultimately, when I was young, you asked me about upbringing. My mother has told me never invest on a horse.
Okay.
Correct? So I'm following her. I'm not investing on a horse. I'm investing on a jockey.
Okay.
So what is that in finance? Horse is equity, stock. Jockey is the promoter.
Okay.
So when I was in my earlier organization, one of my colleague in Goldman Sachs, he was the Asia Pac head. He told me one thing very clearly. And that statement is very important. That statement was mind mapping is more important than the watertight agreement. I repeat, mind mapping is more important than the watertight agreement. What does that mean? Let's take your example. Your company, say you are 70-80%. Your second generation has joined the businesses. Nikhil ji, knowingly or unknowingly, you will not harm your company, come what may happen.
It's my own baby.
Correct. But the day, sorry to say, instead of being a good friend, you start selling your own stake and you come back to 20%, that time your company has a red flag for me. So that time it's like, because,
interest is reduced kind of.
I always tell my investors, so cricket and fund management is technically one and the same. How does that? Let's take a batsman. Okay, there is a batsman who is straight away throwing his wicket. Will you pay a premium to him? No, sir. But a batsman who is putting a price tag to his wicket, you will be willing to pay a premium to him. You will ask me, what is the synonym in fund management? Look at the promoter. A promoter who is selling his equity every day and every night will never get the premium. In that company, only promoter becomes the rich. But a promoter who is holding on his equity will always get a price tag. So exactly, batsman holding the wicket and promoter holding the equity. Support the batsman who holds the wicket, support the promoter who holds his equity. That's the reason substantial promoter shareholding is the key towards the success. You will not have the failures. So many people ask me that what is your pride statement? If I take that question on your behalf, that every fund manager has a pride statement. So my pride statement is certainly not that I almost become $1 billion in asset under engagement is 4 years. No. My series 1, series 2 technically at a gross IRR of 40% plus. No. My pride statement is whatever investments I have done till today, Nikhilji, there is not even a single default. There's not even a single default. Not even one company has failed. And if you ask me why, of course the partial credit goes to the due diligence scheme. But at the same time, more credit goes because substantial promoter shareholding. Each and every company have invested. The promoter has a substantial stake. The second generation has joined the businesses. The promoters are not involved in a multiple businesses. That's the safety because I invested in a jockey and not on a horse.
So we'll go back a little more and see and understand that what are the things which you really look at as a criteria before investing. You spoke about promoter. You spoke about your asset-backed order book. So what more you check in a company?
I'll give you one by one. So technically, this is not a startup game. So I look at the grown-up company. So neither the challenges faces in startup are there. At the same time, the higher valuation is not there because the company is not listed. That is where I get the benefits of both the world. The first criteria is I start with the exit. Mind mapping. If you're giving you the money, sir, are you willing to go for IPO in 30 months? Otherwise, no. That's clause number 1. Second, invariably, I have given money to a simplified businesses, simple businesses. Because ultimately, when I exit, I want to attract other investors also. They will come if they understand the business. So look at my businesses. Haldiram, what do they do? They bhujia, frying the bhujia. Exactly. Vikran Engineering, what do they do? They are into the EPC projects. Millennium Diapers, what do they do? Manufacture the diapers for this thing. Aniket Metal, what do they do? Kitchen utensils. Such a simple project. So that's rule number 3. Rule number 2. Rule number 3 is regional brand growing to the national brand. Again, going to the same thing. Enter low. Most of the time, what we do, we chase the celebrities. Because celebrity has invested, we go and invest. Is that a right strategy? I'm not a right person to comment. But one thing I can tell you, if you are, while investing, if you are following a celebrity, invariably, you are paying a premium for that. So I entered a regional brand and make it a national brand. So when I enter in one of my 3 or 4 of my investee companies, there are brand ambassadors. But I enter before them. So when I entered, the promoter did not charge me the premium for them. But when I will exit, I will be definitely charging the premium for that. So regional brand growing to national brand, that's where you make the money. So simple way, enter low. The 4th point is substantial promoter shareholding. The 5th point, very important in my opinion, is growth capital.
Growth capital means?
I'll tell you. If I'm taking the benefit of my friendly relation with you, when you invest, you look at the valuations. Correct me if I'm wrong. Nikhilji, valuations are like girlfriends. You're not going to get it. I hope you do not have a girlfriend. So valuations are like, you're laughing a lot. So valuations are like girlfriend, never chase that. You need to spend money on your house. So most of the people, because this is an investors education and awareness scenario, in unlisted, you need to look at that. You need to always give money for a primary cause and not a secondary cause. Secondary and primary, I want to explain over here. Secondary means one shareholder selling it to another shareholder, second shareholder selling it to third shareholder. Invariably, when you are investing in unlisted, you are buying some other shareholder's equity stake. In that case, who is getting the money? That equity. This company is getting money? No. So because of your money, can the company's balance sheet grow? No. So if the company's balance sheet is not growing, how come the valuation will grow? That's why I said, do not chase the girlfriends.
Okay.
So what you need to do? Give primary. Give money to the company. Nikhil ji, whatever series 1, series 2, series 3, series 4 I have invested, 87% money I have given primary. Means I have not just the girlfriends. So when you give money to the company grows. Simple explanation. If you give a company as a primary, today company has 12 machineries, tomorrow they will have 20 machineries. As a result, revenue will grow, profit will grow, margins will grow. You can appoint CEO, you can appoint CFO. They will grow your company.
You take the stake from the company.
Correct. Take stake from the company. Do not take stake from somebody.
Secondary market.
Secondary.
Or OTC market, whatever.
Correct.
Yeah.
So in simple way, more simpler way. If you do secondary, the promoter has Honda City. Tomorrow he will buy BMW. If you do primary, the company has 12 machineries. Tomorrow they will have 20 machineries. So you decide whether you want to sponsor BMW or you want to sponsor machineries. As simple as that, sir.
Very good, very good. Yeah.
So primary.
Okay.
So that was the point number 6. 7 point is enter low again. Because what happens, sir? Wherever I have invested, you take out all the investments I have done. Or say any investment I have done. The one that you like. Each and every company has a listed parameter, listed peer. Correct? If you look at the listed peers, revenue multiple or P multiple, vis-a-vis my entry level P multiple or revenue multiple, Nikhil ji, you will find minimum 40% gap. Minimum 40% gap. Why? Because again I said enter low. Because the day I enter, the stock does not have the liquidity. Because promoter is holding maximum stake. 70-80% is held by the promoter. Rest is with me. But the day I get the SEBI approval, DRHP approval, mutual fund come, PMS come, institutions come, the liquidity increases and I encash on that liquidity.
Okay.
So that is where I say enter low.
Okay.
Enter low.
No. So this one, is it because these companies are coming to you as a merchant banker support, or how do you get those companies?
Both, because see, since we have done so many IPOs, Nikhil ji, I'm very honestly, we have a connect of close to 7,000 corporates in India.
Okay.
And that's where we are developing. Plus, Nikhil ji, now have 3,350 investors.
Okay.
Most of the investors are well educated and well knowledgeable. They also know where I'm investing. So they know my selection parameters.
Okay.
So they also comment.
Okay.
So last question, because I gave a lot of explanation, I will just give the parameters that I look while investing. Number 1 is a IPO conviction. Number 2 is simplified businesses, straightforward businesses.
Okay.
Number 3 is invest in a regional brand which will grow to the national brand. Number 4, substantial promoter shareholding. I look at. Number 5, always give the growth capital which is primary. Number 6, entry level discount as compared to the listed peer. Number 7, very important, is profitable businesses.
Okay.
And number 7 is basically grown up businesses having a proven track record. I always show my slide that these are the 7 points I look at. I intend to follow at least 70 to 80% of these parameters.
Okay.
Because if you follow the 70 to 80% parameters, Nikhil ji, what am I giving you? I am not giving you any returns. I am giving you safety. When my company goes for the IPO, I know mutual fund looks at safety and not the returns.
Okay. Correct.
So I know my end game, what mutual fund, insurance and bank, they come on the data of IPO. What is their selection parameters? So technically, my selection parameters is a mirror image of their selection parameters. Only thing, they cannot enter unlisted market where I can enter.
Okay.
So that is where.
So when it comes to market, especially before IPO, pre-IPO market, the biggest fear you have is a liquidity. Then transparency issues are another problem, because whatever you're saying is that you may not know that actually it's happening or not. So how do you really tackle that? And you have successfully done that also. So what is your secret sauce to get those things?
So Nikhil ji, that is the reason we have made a huge investments as a company level into artificial intelligences.
Okay.
Yeah. So I have 2 homegrown artificial apps owned by us.
Okay.
One is called analyst.ai and another one is called as a lead zen.
Analyst.ai
and leads in.
Leads, sir.
Leads in.
Leads in.
Leads in. So leads in is a lead generating ability tool.
Okay.
So as I told you, I have given the money to the promoter. He has 12 machineries, 12 become 20.
Okay.
Is that the end of the show? No, sir. His next question is, sir, I have manufactured now. Where do I sell? There also you have to help. So lead generating ability tool will help him. Okay, go to the Kerala. Here the leads is there. Go to the Dubai. Here the leads is there. It helps you in identifying the leads. And the analyst.ai, any unlisted company, I can find their GST default, TDS default, criminal liability against the promoter, any charges against your company. So whatever the report for the listed company you get, somewhat similar report, I get a 60, 70 page report, I get within 10 to 15 minutes. So even without meeting you,
Okay.
at times I know that how deeper issues you are facing in your company. Because what happens in unlisted, step one, you met the promoter. You like the promoter. You go to his company. Then you do the due diligence. And after 3-4 months, you come to know you cannot invest. What has happened, Nikhilji? Time, effort, and money has gone. Effort can be earned, money can be earned. What about time? Time is the important. But here in my case, even before meeting you, the due diligence, I know whether I can do your deal or not because of my artificial intelligences.
Okay.
So that's where I score, I believe. My AI is my secret sauce.
Okay.
And
So
plus,
you have developed it. Yeah.
correct. Plus corporate connects, which I have been, our team has been meeting, doing so many IPOs.
That is, so this is your internal tool or is it?
This is our in-house tool. This is in-house tool.
Internal or is it publicly available for?
Okay, so now we are trying to make it public because most of my investors are willing to have the access to it.
Okay.
But right now, the management is still under the discussion how to make it public. But right now, it is only for internal.
Internal. So you spoke about the safety mode and everything, right? And what is the risk associated in case if those who are already invested in your AIF?
So what happens is that we always work on a backup plan. The fund that is successful has to always work on a backup plan. So my 3-level backup plan is point number 1, you have to go for IPO in 30 months. Point number 2, if that doesn't happen, I'll give you 6 months extension. After 6 months, I can sell my stake to anybody.
Oh, okay.
And my private equity is equally strong.
Okay.
So it's not only I know IPO game, I know private equity game also. If that doesn't happen, then of course it's a buyback arrangement with the promoters also. Now you have a long runway.
Okay.
You are long runway, so you will not do any wrong things with your company. Ultimately, it all depends upon the promoter's mindset. We always say that give money to the promoter who has a longer runway. Okay. And longer runway is ensured by you are not selling your equity. Your second generation has joined your businesses. You are not upon multiple books of accounts. You're concentrating on one businesses. That's what.
Okay.
Even I'll tell you one thing. Very important factor. If I'm not buying your time. No. You know what is the last stage of due diligence in our cases?
Yeah.
If I'm investing in a company, I'll come and have a dinner at your home at least 4 times.
Oh, okay.
At your home.
Okay.
Not in a hotel, not in office.
Okay.
Any guesses why? Your home.
I think how the functioning at home will tell my character, right? Really.
Absolutely right.
Yeah.
Absolutely right. Nikhilji, I was doing one deal. Okay, without naming the deal, I was doing the deal. Everybody has given the green signal. My artificial intelligence has given the green signal. My team, I have a big team of chartered accountants, they have given the green signal. My other colleague, Prasanna, he went there for the dinner. And that was a metal manufacturing company. On the dinner table, he's asked promoter's sister,
Okay.
what are the ambitions of your bhaiya? Bhaiya means brother. She said, my brother wants to become the largest real estate kingpin of that particular region.
Okay.
Prasanna told me, look, he's talking about the metal manufacturing, and his real ambition is real estate. You take the call because you are leading the case. If you sign, because IC committee, everybody has to sign. You sign, I will sign. You sleep over it, and tomorrow morning you let me know. We backed out. Because your mind is not tuned for that business. What am I doing?
Yeah.
I became chartered accountant because I wanted to become chartered accountant. Forceful, if you become chartered accountant, I'll never be successful. So that's what.
No, I had another question, but I think you gave me the answer because you spoke about the percentage of holding. But how do you really assess the character? I think you
have to. So we always meet promoter as their home. Okay. And in fact, most of the promoters, we make it mandatory to have the drivers. They do not drive. Because you are managing such a big business, you are not supposed to be concentrating on 2 things because your phone will keep on ringing. However, you stop it. It's not about drink and drive. It's about
mind is there.
Exactly. Your mind has to be free. So that those things, even concentrating on the workers' toilet, woman empowerment. So Madhu, wherever goes, She visits the workers' toilet and she tells, because ultimately workers are giving you the money, the toilet has to be good, well done. Number of women empowerment, that also we took care.
Yeah, even one of my professor, he was telling me that he was into production and operation professor, and he tells that I don't know, Japanese, they always do this. It seems as a trick, they go to the toilet and see. First visit, they will go to the toilet, especially for the Six Sigma project and all. They don't look at the report every all. They just go to the toilet and see that how these guys are really doing at the toilet. If toilet is clean, that's the first tick.
True, sir. True, sir.
Yeah. And when we speak about and there we are talking about the 1 crore portfolio, right? So why we as a investor, they need to give this 1 crore to Bharat Value Fund instead of mutual fund we have, PMS we have, other AIFs we have, listed companies we have. So what is the difference, or how you gave me all the answers, but what could be the highlighting figure which you can talk about here?
Many of my investors ask me a question that, sir, I have seen in Google, I have seen in other fund managers interview that unlisted environment can give you better return than the listed. That is what is Google is saying, many fund managers saying. Is it a true statement or a false statement? So let me answer that question. Unlisted can give you better returns than the listed is a correct statement, but it's a half statement. Unlisted can give you better returns than the listed. Probability, provided the fund manager knows how to make an exit.
Okay.
Because if you fail to exit, the money never comes to your bank account. It's a paper return. So what Bharat Value Fund gives is there is something called as an unlisted environment. Okay. And we know exits very well. So exit-oriented unlisted environment where mutual fund and PMSs cannot invest. Ultimately, to diversify, your first question, where have you invested your personal money? And my answer was AIF, PMS, mutual fund, listed equity, gold, silver, everywhere, and FD, everywhere I invested, diversified. So to have a diversified portfolio, you need to have the exposure of unlisted atmosphere also. But sorry to say, this is the space where I would not advise investors to play on your own. You need to give money to a professionally well-judged person who knows, Nikhilji, how to make an exit.
Okay.
Next time any fund manager comes to you, unlisted, you should ask him, not how are you going to enter, not how much money you want, not how much return you give me. You need to ask him, sir, how are you going to exit and what is your exit credibility, what is your exit background?
Okay.
Because if he can exit, trust me, 9 out of 10 times, he will make the money for you.
Okay. So since you said this, what will be the criteria for exit from your perspective?
So, of course, you should know, sir, how to do the IPOs. You should know how to perform the private equity exits also. So, the main exits mode, of course, you can do the mergers. You can list the company or you sell it to some other private equity player. So, you should have performed these kind of exits in your previous track record. Okay. That is what I mean. Say, my parent company is Pentoman. They have done 119 IPOs. In the month of August, 1 month, we have done 3 main board IPOs. So that's the background about the guru. We come from so remember my statement. Enter the company, nurture the company, exit the company. This was told to us in a educational background world. When I entered the realistic world, I came to know exit first. So in wealth company background also, Pentomath was exiting first. Then wealth company started the entering. Okay. So exit first and then enter. If the exit is not there, no point in entering.
Okay, so especially you wait for IPO and you get out, or you hold it then?
Okay, to legally answer, your question is, the legal term for your question is called as a OFS, offer for sale. Okay. So the way I draft the shareholders agreement, I have right to get out in OFS, but not an obligation.
Okay.
Means when the IPO comes, I want to sell it to a mutual fund and get out, I can get out. But if I want to continue, that right is with me. I have created that right. Whether I want to exercise or not, that's up to me. Having said this, most of the time, I would love to exercise that right.
Okay.
Because again, Nikhilji, exit, money comes to a bank account.
Yeah. That makes a lot of sense. And another thing which we were discussing also, who will be the ideal customer for this fund?
My chief business officer and my good friend Prakash Jain, in most of his webinars, he always tells investors that, look, Bharat Value Fund is a good way, unlisted investment is a good way to diversify your portfolio. But in my personal opinion, this fund is only for those investors whose liquid balance at least is in excess of 5 crores. Okay. That's my personal opinion. If you want any money, since my series 1 has given the fantastic return, series 2 has given more returns. If you're giving me the money that you wanted money back in 3 years for your daughter's marriage or child's education, no, do not do that. Again, this is a test match. This is not a T20 at all. By any source of imagination, Bharat Value Fund is not a T20. It's a perfectly well-played test match by the seasoned professionals.
Good. I think most of the time, I have come across, especially when we do financial planning, we see some of the people who have invested in AIF, even PMS, and I have come across one client. He didn't even know that it's called mutual fund. he had, he thought it's a mutual fund. He had a good FD. And somebody said that why you put it in this one? There is a AIF, and he then actually exit was little delayed, and he didn't know that it can be delayed because he's telling that I'm okay to give the penalty because in FD that is the case, right? So he was telling that they have cheated me. I said it's not like that. Actually, the person who sold. And when you bought also, you both didn't understand what is a product you are entering into that. So that is actually even our requirement also. So what will be your advice for me in order to manage clients and recommend this kind of products?
Okay, Nikhilji. One of my investors just asked this question to me that Nishad, many unlisted proposals comes to me. How do I select the unlisted fund managers? I tell you, next time any unlisted fund coming to you, evaluate them on 3 parameters. Like the great Lord Newton has taught us, the world works on 3 parameters. So today I'm going to tell you the 3 parameters on which you can evaluate a fund. This is not there on ChatGPT. This is not there on YouTube at all.
I think after today will come.
So rule number 1. If you exit, the money comes to a bank account. If you do not exit, that money lies in paper, and that paper and tissue paper has same value. So you should know how to exit. Ask the fund manager, how can you exit? Mr. Ram will exit, Mr. Shyam will exit. No, sir. Can you exit? Do you have the exit credential? That's rule number 1. Rule number 2, valuations are like girlfriends. Never chase them. Invest money into the company. Means primary. Make primary investment, not secondary investment, because you should believe in increasing the balance sheet size of the company. As a result, valuation should go up. If your knowledge goes up, your salary goes up.
Okay.
Directly salary goes up without knowledge. Today it will go up, tomorrow it will come down. So that's rule number 2. Rule number 3, just like cricket. The team wants who's batting, bowling, fielding. All 3 are superior. Correct? Batting, bowling, fielding. So what is synonym of batting, bowling, fielding in fund management? Enter, nurture, exit. We should know all those things. Nurturing is all about my artificial intelligence is that I have. Give money, lead Zen, analyst.ai so that you do not default. Exit, which I have been speaking for the entire presentation. That's where the pentomet comes from the picture. And entry, that's what I have showcased. So enter, nurture, exit. All 3 credentials. So in a summarized way, number 1, if you know exit, the money comes to a bank account. If you fail, that remains in paper. That paper and tissue paper has same value. Okay. Number 2, never chase valuations. Valuations are like girlfriends. Give money to the company, not to the shareholder. Okay. And number 3, give money to the fund who knows enter, nurture and exit. Okay. If you put 3 ticks to any fund manager, me or somebody, if I fail on 3, do not give money to me. I would say the probability of success should be very high.
Okay. So we need to choose fund manager like that. Yeah, okay. Very good. Thank you so much. I think there is a lot of learning, and I was really looking for someone who can really speak about AIF. And today, I'm really blessed to see that you came and give the time to us, and not only to entire wealth company, my thanks, and our Kerala regional head also, Joseph sir also. Thank you so much. My audience are very serious people who have I think almost half is NRIs, and very serious people. They will have a lot of learning from you. So thank you for taking time out and enhancing this knowledge session for us.
Thank you, sir. Namaskar. Thank you very much. Thank you.